Okay. First of all, thank you all for participating in today's session about new technologies in accounting. We have three very interesting papers. And before we get started with the papers, let me first remind you of the format a little bit. We're going to have 25 minutes presentation by the authors and 20-minute discussion after the presentation by the author. And after that, we are going to have a 15-minute Q&A session. There are a couple of ways you can ask questions. You can either type up your questions in the Q&A window on Zoom. Perhaps a better way is just to click the raise hand button, and I will allow you to talk directly to the to other participants of the conference. Okay. So let's first get started with the first paper, Information Acquisition and Expected Returns Evidence from EDGAR Search Traffic, presented by Li Weikai. Li Weikai is a professor from Singapore Management University, Finance Department. But of course, this paper is very interesting to accounting audience and very relevant to accounting audience as well. So Weikai, you are going to have 25 minutes. Time is yours.
Okay, thank you, Wenjie. Let me start by sharing my screen. So first, I want to thank the conference organizer to include our paper in the program. So this is paper Zhang with Chengzhu, who is also attending the session today, and she is going to join Hong Kong Polytechnic University very soon. So the paper is motivated by large theoretical literature in costly information acquisition. So the seminal work started by Grossman Stiglitz in 1980. So in their model, they argue that information acquisition activity should be a function of the perceived benefits of information and also the cost of acquiring the information. So information acquisition will be more intensive when the perceived benefits of trading or utilizing information is greater, and it also will decline when the cost of acquiring information is too high. So key testable prediction from this type of model is that if you hold the cost of information acquisition constant, then more investors will choose to become informed when they perceive great benefits from doing so. So if we observe measure a proxy for information acquisition activity, it's possible to back out or infer the information content from this quantity. So a simple analogy is that if you observe restaurants with long queue, then it should probably signal that the food in the restaurant is probably more delicious than otherwise restaurant located in the same place, but with very few people waiting in the queue. So the idea is quite simple. However, the challenge in the empirical testing is it's hard to come up with a information acquisition measure that can capture a broader section of the stocks. So in this paper, we are going to use investor download SEC filing from EDGAR system to measure information acquisition activity. So the advantage of EDGAR system is that it's the main source of the firm's regulatory filing. And we can observe investors downloading of EDGAR filing for almost any firm in the US, publicly listed in the US stock market. And the previous study showed that EDGAR users tend to have high educational level and are more likely to work in major cities with more accounting and finance job. So it likely measures sophisticated investor information acquisition activity. So with that data, we are going to study a twofold research question in this paper. The first one is the determined analysis. That is, what factors drive investor information acquisition through EDGAR. And the second is the main testable predictions that we are going to test using the data. That is, does the cost of information acquisition activity really reveal the value of information? So let me briefly talk about the data. So the data we're going to use is the EDGAR search volume from SEC's log file database. So the EDGAR data contains information on users' unique IP address, although it's partially anonymized, so it prevents us to fully map the IP address to the identity of the investor who is conducting the downloading. But still, we can still identify some type of IP behavior because IP is unique. It also contains a timestamp when the investor access the filing, and the company that investor is downloading filing from, and also the type of SEC filing. And because we want to study humans' information acquisition activity, we follow the literature to limit requests made by robots and the automated web crawlers. So our measure of information acquisition activity is the number of unique IP address aggregate to firm month level. And we construct three main measures to capture investor information acquisition activity on different type of SEC filing. So first, we simply count the total number of unique IP address searching for any type of SEC filing. So including annual accounting reports or quarterly reports, but also including Form 4, which is inside the filing, and also include registration filing and also the proxy statement. So the second measure, we specifically count those IP address that only search for periodic accounting reports and also the AK filing. And lastly, we specifically focus on the 10K filings. So these are the three measures we are going to use in the paper. So other data are quite standard. Stock return from Chris, accounting data from Commerce data, analyst data from IBES, institutional holding from Thomson Reuters, and the security lending data from market. So caveat about data, EDGAR data is that it does not capture all the views, all the downloads that the entire universe of investors are conducting on the company filing. Investor can get access to this filing or this information from alternative source, such as firms' investor relation website, Yahoo Finance, or Bloomberg, and other data vendors. However, EDGAR still possesses several advantages relative to this data aggregator. So first, some firms forward the invest directly to the EDGAR website to obtain their SEC filing. And other sources often condense accounting information into pre-specified bins, and that can lead to misclassification or omission of certain important variables. And lastly, investors can read the firm's qualitative disclosure by reading the MD&A section of the annual reports, or they can, if they want to look for more detailed information, they can check the footnotes contained in their annual reports, which are usually available in these data aggregators. And so that's why we believe that EDGAR's data is still quite useful to measure, or at least is a proxy for the invest information acquisition activity overall. So this is a simple summary statistics. So we in this figure plot the median number of IP address over our sample period. And as you can see that the increasing trend of the number of IP address searching for firms, SEC filing. And then we check for some seasonalities in the EDGAR searching activity. So for the IP, so the panel A shows that for the total number of IP searching for all type of SEC filing, we don't find a very strong seasonality. And for the IP that only search for 10K, unsurprisingly, we find that larger number of IP address search the firm filing during March and April, which is not surprising because the majority of US firms have December fiscal year end. So March and April are the earnings season when the firm files annual reports. But still, you can see that even in other months, we still observe a significant amount of IP searching for SEC filing. So to study the first question, we develop a simple characteristic-based model of expect information acquisition, which is motivated by the series. So we expect that investors are more likely to search firms with higher visibility and more attention grabbing, because these stocks are more accessible in investor mind. And we also expect that public information environment can affect the information acquisition, although the sign could be either positive or negative, depending on whether public information complements or substitutes private information acquisition. And lastly, we believe that firms with more valuation uncertainty should attract more information acquisition because the marginal value of information should be more valuable when the valuation uncertainty is high. So to capture these motivations, we use each variable to proxy for each firm characteristics. So we use size to proxy for investor availability and trading volume proxy for investor attention. And we use analyst coverage to proxy for public information environment. And we use idiosyncratic volatility to proxy for valuation uncertainty. So then we run cross-sectional regression of the log number of IP on a firm and on these 4 firm characteristics. And to facilitate comparison and also the marginal contribution of each variable, we add each variable, we first add the size and then add each variable one by one. So you can see that in the first column, the size alone explains a significant fraction of the cross-sectional variation in the information acquisition activity. So the average R square is already 40% if we only include the log of firms' market capitalization. And then we add the analyst coverage, and we find that the coefficient equality suggests that public information environment actually complements private information acquisition. And then we add turnover, and the sign is also expected, which is positive. And finally, idiosyncratic volatility also increase information acquisition activity, which is consistent with the prediction we have in mind. So you can see that in column 4, these 4 firm characteristics can explain up to 55% of cross-sectional variation. And we choose this column 4 as our baseline model to measure the expected level of information acquisition. And we use the residue from this model as a proxy for abnormal level of information acquisition, which is not explained by these 4 firm characteristics. Of course, we can add more variables. We find that all variables like passive return, book market ratio, institutional ownership, a dummy indicating stock belong to S&P 500, and whether the stock is in the earnings announcement season. These variables all significantly related to the information acquisition. Although the t-stats are very large, but if you look at the incremental R square, if we add all the 9 variables, the incremental R square is only 3%, which is quite small. So that's why in our baseline model, we use these 4 firm characteristics for parsimony. But our result also hold if we use a more comprehensive model with more firm characteristics to proxy for the expected level of information acquisition activity. So with that, we studied the second question, that is, does the cost of information acquisition reveal investors' expected payoff from using that information? So in theory, the more informed investors choose to become informed when they perceive a great benefit from utilizing information. So if we observe the quantity of information acquisition, we can infer or back out the implied value of information. In theory, the direction of information could be either positive or negative, but in reality, due to the asymmetry in the buying or selling decision, and also due to the difficulty of shorting stocks, especially for retail investors, we believe that investors will more likely engage in costly information acquisition when the expected payoff is positive. That's why we can have a directional prediction between the information acquisition activity and the value of information. So our proxy for the information acquisition activity is a normal number of IP from the model I showed you in the previous slides. And we first verify the information content using abnormal stock return. So we conduct the standard portfolio sorts by sort stocks into DCL portfolio based on AIP at end of each month. And we compute the cohort 4-factor alpha of each DCL portfolio over the next month. And this figure shows you that the abnormal return of the DCL portfolio almost monotonically increase with the abnormal number of IP searching for firms' SEC value. And if we look at the AIP 10K, which is the IP searching for 10K filing, a long-short portfolio based on the AIP can generate a 4-factor alpha of 82 basis points. We found the weaker results for value-weighted portfolio. So this suggests that the information content is stronger among small stocks. And I will get back to this point later. And it's crucial that we need to control for the expected level of information acquisition when trying to uncover investors' expected payoff. You can see that in this figure, we simply sort on the raw number of IP, and you can see that there's almost a flat relation between IP, number of IP, and stock return. And the reason is because the large raw number of IP could be driven by low cost of information acquisition rather than high benefits. So we need to control for the cost of information acquisition in order to back out the benefits of utilizing information. Again, using the analogy I just mentioned, a restaurant with long queue does not necessarily mean the food is delicious. It may simply because the location of the restaurant is very good. It's easy to access. So we need to hold the cost of accessing the restaurant fixed in order to better or more accurately back out the information. So that's the idea. And then we conduct a battery of robustness checks using different pricing models. And you can see that the results are quite robust. And so a key assumption in the test is that especially retail investors, face short sell constraint. So only when they have some port information, they will start to acquire information, to spend effort to acquire more information. So we should, under this assumption, we should expect to find a stronger return predictability for stocks with a higher short sell constraint. So we use several different measures to proxy for short sell constraint, including idiosyncratic volatility, institutional ownership, a residual analyst coverage, and more specifically, we use the lendable supply and the lending fee as a proxy for short selling constraint. And you can see that with all 5 measures, we all find that the return predictability is stronger among the stocks that are more constrained in short selling. So this confirms our hypothesis. And then another key prediction from cost of information acquisition is that the implied benefits of information should be proportional to the cost of analyzing the information. Again, use an analogy of restaurant. A restaurant of long queue, despite located far away from the city center, should indicate a very delicious food. So if people are still willing to spend time, effort to get to a restaurant that are very difficult to access or very time consuming to access, then you can infer that the restaurant must have very delicious food. So idea is the same in our test. So we argue that for information that is more complicated and more costly to analyze, if you still observe investors are willing to acquire information, then the implied benefit should be greater. So to test this hypothesis, we use the filing size and also the word count in the 10K to measure the complexity of the filing. And when we do a double sort based on the filing size and also the word count, we find that the return predictability of abnormal number of IP address searching for the filing is indeed statistically stronger among the 10Ks that are larger and lengthier. So that's another prediction that we checked using the data. And one more thing we did for this hypothesis is that if investors are willing to search both the current and the historical filing, they want to confirm something using historical filing, then it indicates deliberate information acquisition. And so the return predictability should also be stronger. And we also find this is the case. So we also confirmed that the return predictability of the abnormal number of IP is robust if we control for the standard cross-sectional return predictors in the Farmer-Mabes regression. And the economic magnitude is that we find a monthly return spread of 105 basis points between 2 extreme deciles. So finally, we will test the channels of the return predictability. So again, our hypothesis that on the short sell constraint, investors would rationally allocate more effort toward undervalued firms with larger price appreciation potential. So there are two non-mutually exclusive channels to identify mispricing. So any mispricing is a decoupling of the fundamental with stock price. So it could be that the investor can identify firms with improving fundamental that have not found its way into stock price yet, or investors observe exogenous shock to stock price that are not warranted by firm's fundamental change. So we test both channels. First, we examine whether the abnormal number IP can predict future changes of firm's fundamental, and we use 3 proxies for firm fundamental, including change of the ROA and standardized unexpected earnings and monthly forecast revision of analyst consensus forecast. And we found that AIP can significantly predict all 3 measures of firm's fundamentals in the future. And then we test the second channel, which is that investors may observe some exogenous shock to stock price that are not warranted by firm's fundamentals. So the literature, one measure proposed by literature is using mutual fund outflow induced fire sale as an exogenous shock to stock price, as this measure is not likely to be related to firm's fundamental information. So we follow Edmonds, Goldstein, Zhang to construct outflow measure, and you can see that when a stock experiences severe outflow, its price will temporarily be underpriced, but over the long run, it will revert back, suggesting that this is potential underpricing. And under our hypothesis, we predict that investors will spend more time. Investors will start to acquire information on such firms because the potential benefits is greater. So we examine whether the outflow measure can predict the future changes of the abnormal number of IP searching for firms SEC filing. And we find evidence that outflow measure can, when a stock experiences severe outflow, then in the next quarter, there will be more investors searching for firms SEC filings. So, so these 2 tests support both channels of the underlying return predictability. So lastly, you may wonder that if investors already know which firms are potentially undervalued, even before analyzing SEC filing, what is the incremental value of acquiring information through EDGAR? Our conjecture is that acquiring fundamental information through EDGAR could help investors identify those truly mispriced stocks. So the idea is that if you observe some signal or noisy signal about firms mispricing, it's not very accurate. You want to spend time and effort to confirm that the signal is reliable. And given your time and effort constraint, you would allocate more effort and time towards those stocks where you think the potential benefit is greater. So to test this idea, we use a composite mispricing measure from Stanbong Yuan to identify mispricing. First, we check whether investors indeed search more for firms with potential mispricing, underpricing signal. So we find that this figure shows you the average AIP across the 5 portfolios sorted based on their mispricing score. You can see that the number of investors searching for EDGAR filing is indeed the strongest among the most undervalued stock. Again, this is consistent with most of investors face some kind of short sell constraint. So it will not worthwhile to spend time and effort on those most overvalued firms because you cannot trade on this information anyway, or the abnormal profit after subtracting the short selling fee will be minimum. So that's why investors are willing to spend more time and effort on those firms that are potentially most undervalued. And more importantly, we find that accessing EDGAR filing can help investors identify truly mispriced stocks from those sharing similar mispricing characteristics. So we do a double sort based on the abnormal number of IP and also the composite mispricing measure score. And this is a 3D plot of the abnormal return for the 5x5 double sorted portfolio. So you can see that among the most undervalued quintiles, the number of investors searching for SEC filing, the AIP can help distinguish the truly mispriced stock from those share similar mispricing measure, but actually not mispriced. So if you focus on the most undervalued quintile and also search more by investor, the monthly abnormal return is 1%, while those similar mispriced stocks with minimum invest searching activity has almost zero abnormal return. So this suggests that investor cost information acquisition activity are being compensated through higher return from trading on the information. And we also did several tests to rule out many alternative hypotheses, including confounding events from firm announcement and also media coverage. And in particular, we distinguish the information-driven return probability with price pressure-driven return probability. So under this attention-driven price pressure, the return probability should revert over the long horizon. So we check for the return probability over the next 24 months. So you can see that actually the return probability persists for around 6 months and then gradually levels off, but it never reverses, suggests that the return is driven by the fundamental information rather than temporary price pressure. And lastly, we believe that given there are more than 30 million unique IP addresses, most of the investors using EDGAR should be retail investors rather than institutional investors. So we look at whether the abnormal number IP can predict subsequent trading behavior separately by mutual funds and the retail investor. So the two type of investor can the table shows you the results that AIP can only predict the net purchase by retail investors, but not by the mutual funds. So it suggests that EDGAR search mainly capture retail investor information acquisition activity. So this is consistent with several recent studies shows that if you aggregate the retail investor order flow or order imbalance at a stock level, it's actually quite informed and can predict the future stock return in the right direction. So the measure we use is borrowed from Boehmer's, Zhang, and Zhang. They identify retail orders for almost 70% of the trades. And then they find that the retail order imbalance predict return in the right direction. And our evidence suggests that EDGAR searching actually a leading signal for investor subsequent trading behavior. So let me quickly conclude. In this paper, we use a novel data set containing invest access of SEC filing to measure information acquisition activity. And we find that abnormal number IP searching for SEC filing strongly predict future returns and the fundamentals. And it provides direct evidence supporting theoretical models of costly information acquisition. And we also highlight that it's promising to use the collective wisdom of investors to infer some important economic outcomes. Okay, so that's all for my presentation, and I look forward to Bohui's discussion.
Okay, thank you very much, Weikai, for the presentation. Let's welcome Professor Zhang Bohui from Chinese University of Hong Kong, Shenzhen, to discuss the paper. Bohui, you have 20 minutes. I hand over the time to you.
Okay. Thanks so much for the opportunity to discuss Weihai's paper and also with Chengzhu. I think Chengzhu is also here, right? So let me give you a quick summary. Sorry, my internet may not be stable, so I will try to reconnect later if it was disconnected. Okay, next. Let me give you a summary. The paper studied whether and how abnormal number IP searching for the for companies' financial statement in SEC's EDGAR system and predicts stock returns. So this is the main objective of the paper. And they have a, I think it's a long sample period. They use monthly observations and from 2003 to 2014 and roughly 12 years sample period. There are several main findings. The first finding is abnormal IP addresses searching for such information indeed predicts future stock returns. And definitely there's a theoretical explanation. And also we can provide those explanation in the paper as well. Moreover, they show that such measure can also predict firm fundamentals. So there's positive prediction or positive relation between AIP and firm's fundamentals. The third thing is that this prediction is pronounced for certain types of scenarios, such as the firms with lengthy financial filings, and also for those users who search such information and searching for both current and historical filings. And also there are some other cross-sectional evidence. So what is the implication? The implication is that investors' costly information acquisition indicates their positive information about firm fundamentals. Okay, so this is the main finding. So the paper actually has what is the summary of the paper? The paper has several sessions, in total 7 sessions, and 74 pages, 12 tables in the text, and 12 tables in the appendix. And also the paper has already been presented in many top-tier conferences and also universities, so well circulated. In that extent, from this side, so I feel that it give me very little room to add more new insight into the paper. And also the paper really has a rich discussion and a rich empirical analysis. So I was trying to use a different approach. Instead of offering new comments for them to conduct more tests, I try to focus on a way how to shorten and sharpen the paper, and how to remove some tables, and how to focus on some key tests instead of providing or creating more tensions. Okay, so this probably different from the conventional discussion. And so what is the main argument of this paper? The main argument is that suddenly a firm has a large number of abnormal IP searching for firms of financial information in EDGAR. So it indicates something. It indicates because such a searching activity is very costly, it normally indicates investors' expected benefit of trading. So it's well guided by theoretical models, right? So if we dig this intuition a little bit deeper, so you are going to have two sides of the story. On one side, you could have bad news, negative information. You still can get trading benefit, trading profit. And on the other hand, you could have positive information. But here we have some asymmetry in trading. And not all the short sellers, they can conduct short selling to sell a stock in the market. So investors are facing short selling constraints. So the possibility of trading for negative information would be very marginal, is very small. So in that case, the main intuition, only positive information left. So it indicates that in future, stock price increases, you are going to observe some positive future stock returns. The logic, I think, is quite clear. And the increase in abnormal IP searchings indicates this trading benefit because downside is not so possible due to short selling constraints, and only positive information left. So positive future stock returns. Okay, so to further to confirm that this explanation is confirmative, and definitely readers would come up with a lot of alternative explanations. Actually, when I read the paper, and it's probably my second time to read the paper, because actually 1 or 2 years ago I discussed this paper with Weikai. So at that moment I had some alternative argument, and also this time I also have a couple of alternative arguments. But later on I realized those alternative arguments actually they are ruled out in the paper, such as there's a possibility people just or investor attracted by some other information and then they read it and for attention. So information acquired from EDGAR will not provide some additional value. Okay, this is one possibility. And another thing is that all this sudden increase in IPs correlated with firm events. And also it could be related to the change in breadth of ownership. And I have a related paper, we are still working on it. We have been working on the paper for 4 years or 5 years. So we try to use this IP searching address as a measure of investor recognition. But in that case, you should observe a negative stock return instead of positive stock returns. So this possibility is not so possible, right? And attention, because Dodger has the paper, they could come up with the search volume. It's similar to Dodger's search volume measure of investor attention, right? Or alternatively, it's driven by media coverage. You can see that there are all possible explanations. It's on Weikai and also his co-author's shoulder to show that the main argument is not driven by these alternative explanations. I think in the later part of the paper, just now, they didn't have so much time to present their test on the to rule out alternative explanations. And I can guarantee that they have done such job. They try to rule out these alternative explanations. I think so far I'm convinced it's not driven by firm events, not driven by investor recognition, definitely not driven by attention-driven price pressures. So I have a stronger belief on the main argument is driven by the acquisition cost. But definitely at this moment, you still can come up with 1 or 2 more alternative explanation. But you know, they have already tried so hard to rule out so many. I feel not so comfortable to read 1 or 2 more for them to address. So this is my feeling about explanation, the argument, the main argument makes sense, right? Okay, I'm going to talk about the results, and then I will provide my comments or my thought how to sharpen and get the focus of the paper. In table 2 just now, and Weikai and also his co-author, they have this main table to show that IP address actually linked with these conventional variables, such as firm size, such as media coverage, idiosyncratic volatility, momentum, institutional ownership, and S&P indexation, and all these variables. To some extent, my feeling is that the results are somewhat expected, and because you know larger firms and also firms get more these a larger or greater institutional ownership. In principle, they should have a larger fraction or larger number of IP addresses. So I feel that this part first is not so surprising, it's somewhat expected. Second thing is that the focus of the paper is on AIP instead of IP, is on the change in IP. So why do we want to distract readers' attention and in table 2? So my thought is we just drop this part, or we drop this table. So to cut this content, to start with AIP first. Okay, this is one part. And also in the result part, in main section, they start from section 4. they have portfolio analysis, they have robustness checks. And in section 4.3, they come up with many cross-sectional tests to show that the result are more, the return prediction is more pronounced in one set of firms relative to another set of firms. And they are all their tests. I appreciate their effort in coming up with all these cross-sectional variations. My feeling is that we could use this result more efficiently. And definitely we can see like some cross-sectional variation, but it's better to put this result or move this result into the test for channels or test to rule out alternative explanations. For example, you have the test on firm size. I feel that it's somewhat related to section 1, the channel, to show that it's related to firm fundamental. When the firm is a small and poor information environment, hard to understand firm fundamentals. So by reading information from EDGAR, will provide more information to investors, right? And also you show that the results for firms facing arbitrage constraints. So instead of using it as a cross-sectional test, I think that could be considered as a new channel. And this is the one channel, right? And also you have this test for complexity of financial filings and also heterogeneity at IP levels. My feeling is that this test can be used to rule out the possibility there's a little value of acquiring information via EDGAR, okay? So this is one part. Another part is that you show that in section 4.5, abnormal IP address searching positively predicts stock returns around earnings announcement. This result is quite nice, but somewhat is related to your test on firm fundamentals in section 5.1. So my feeling is that this test also belong to the analysis on section 5.1. If I'm going to put this result into section 5.1 to strengthen this part, is similar to ROA, ROE, or other revenue test. And also online table A7 can be merged with table 9. And section 4.5 can be merged with section 5.1. Okay. In section 6.21, in almost the last part of the result of the paper, actually you try to show some trading evidence. I think this part is very important. You show that it's related to retail order imbalance. It's not related to mutual fund investor or other institutional investors. So this result is quite nice. So this trading test is important to validate the key implication of the main argument of the paper. In that case, I feel not so comfortable that the current test is based on the lead and the lag test, because this is at a quarterly and monthly frequency. If they are going to acquire information in these months, they are going to build up their long position as well this month. They don't have to wait for the other months, right? Our financial market moves so fast. So in that case, I hope that we could conduct this contemporaneous test. So this is not so much, I'm not going to suggest you to add a new test, but this is one part. You may want to use contemporaneous analysis instead of a lead and lag test. The intuition is that these investors, they are going to increase their holdings when checking the abnormal number of unique IP address, okay? And the last slide is about other comments. So in the last test, you try to show the robustness. Instead of using the abnormal increase in the number of a unique IP address. You also try to use searches, and appreciate that this result is very strong. But I feel that this result should also belong to section 4.2, robustness checks and alternative implication. It's also belong to test to show the robustness of the evidence, right? And also sections of 5.6 can be merged together. In that case, we don't have to have so many sessions. And in section 5.3, you have this test for the anomaly-based mispricing. You mentioned that whether it's the case and the investor identify mispricing and then they read it, or the other way around. I think this is a test to rule out alternative explanations instead of channel test, right? Definitely, maybe I'm wrong. And if you really want to do more tests, I still have something you can give a try. And the first one is the location of IP addresses. And based on IP address, you can have the location of those internet users who read and who learn a financial statement from EDGAR. You can identify which city they are from. For example, are they from the financial headquarters or the local investor? I feel like maybe there are quite a lot of local retail investors, home buyers, right? They are going to read it. So it's not driven by some investors from financial headquarters. This is one thing. The second thing to further confirm is driven by information. You can check how this measure is related to insider trading, right? The last comment, I wonder whether there's any change in, if it's a risk story. So in principle, because in future there are positive returns, so now there should be, in principle, negative return. To rule out this is driven by risk story, you can check the abnormal increase in the number of IP address and then contemporaneous stock returns. Okay, so I'm not going to suggest you add too many tests, just a few. And conclusion, I think research question is a novel evidence, and so it's probably one of the first paper and to use this very simple measure to come up to measure the information acquisition benefit, right? You have a next theoretical implication. Empirical tests, as I mentioned earlier, so many tables, so many tests. Then the next question is how to shorten them, right? And the main comment is the writing could be further polished, and then the paper can be further condensed. Good luck with the paper. Thank you.
Okay, thank you very much, Professor Zhang Bohui, for the very detailed discussion of the paper. And maybe Weikai, can you can respond to Bohui's comments a bit?
Yeah. I just want to say thank you to Bohui for the very insightful discussion on the paper. I agree with you that the content of the results actually a bit of spread all over the place. So it's not easy to link the results all very closely. And this is probably because the paper already, we have already rewritten, and also the new results being added up to the paper in different time periods. So you know that the new results add, you probably with the first place in the end, and then you have to really figure out time to synthesize all the results together. So I fully appreciate your guidance and suggestion on how to put the different parts of results together and then make it more condensed. And also, I think the new tests you suggest are definitely very good, and we should definitely check these, like location of IP address and also checking with the contemporaneous correlation. So we will do this test as you suggested. Okay, thank you very much.
Okay. So now is the Q&A session. So if you have questions, you can either type in the Q&A session, and a better way is just raise your hand, and I will allow you to unmute to talk directly to the presenter and discussant. Okay, I don't see any raised hands, but maybe I can ask the question first, and when others are still like preparing for their question. So there are two things I have in mind. The first is that I think in accounting, right, there's a big literature about accounting conservatism. So I find something similar here. That is we thought about the positive abnormal return, negative abnormal return are different, are not symmetric. One way of thinking about a conservative accounting reporting is that because here you are like looking at 10K, right? So it's basically accounting information. Is that when people say that when the reporting is very conservative, there are a lot of negative reporting, reporting of bad news. But at the same time, there are a lot of false negative. In the sense that, well, although that people report conservatively, but a lot of those negative news are false negative. The consequence of that is that the negative news are not very informative because they have a lot of false negative, right? So I'm not sure if that can be connected to the result you have, because also Bohui mentioned about a lot of alternative explanation, and this is one I can think about. This has a lot of accounting institutional things in it, but maybe you have already thought about it before.
Thanks a lot for your comments, Wenjie. Actually, this is one alternative that we have not thought about before. So I need to check the literature and see what are the specific predictions that can potentially explain our results. And I may also email you later to ask for some related literature. And then definitely we can do some tests to try to test this alternative. Yeah, thank you very much.
Okay, so I have a different thought about the test, because what I learned from Grossman-Stiglitz is that when people are acquiring new information, right, it's not that everybody will acquire. The marginal benefit is actually endogenous, in the sense that if more people acquire this information, then the marginal benefit will diminish as more people acquire this information. So I think what you're testing is not the it's not the I'm not very familiar with the terminology of empiricist. I'm a theorist, because what you're testing is the total number of abnormal. I'm not sure about the details of the test, but what I would expect is that on the margin, right? If I have one additional information acquisition, one IP search, then that should actually be associated with a lower information content. At least I think quotationally, right? Because this is not suggesting that the theory is wrong. It's just that on the margin, right? So as more people acquire information on the margin, the information content should be actually lower. Yeah, that's just a random thought.
Yeah, I think this is a very good theoretical question. So let me clarify it. So there are two predictions of the endogenous information acquisition model. So one is that if you test the equilibrium prediction, then the quantity or the number of investors acquiring information should be proportional to the value of information. However, I also agree with you that on the margin, if you have some exogenously increased number of investors acquiring information, then these investors were going to impound the information into price, and then the price will become more efficient, and then the benefits of acquiring information further will be reduced. So the key that to test the distinguish the two predictions is to see whether the information acquisition activity you observe is already at the equilibrium, or you have some exogenous shocks that increase the number of investors searching for information. So the prediction will be different. So our model, in our approach test, our test is completely an endogenous regression. So it's not that the number of IP can cause the future increase in return. It's actually the reverse. It's because these investors expect the future stock return will be high, so they spend more time and acquire the information today. So this is actually a reverse causality test that we conduct in the paper. So I think if you want to test the prediction you have in mind, then we should find some IE instruments or the setting that exogenous increase the number of investors searching for information. And then what we can find is that in the future, subsequently, the price will become more efficient. And so there will be less mispricing. So that is a net test that we have not conducted in the paper. Yeah, we are testing the equivalent relation.
Yeah, I'm just thinking maybe, I know the difference between the two, of course. I'm just thinking like maybe if you have that kind of test, you have a lower bar for alternative story because you are really testing the both sides of the mechanism in a very comprehensive way. Instead of having cross-sectional test to rule out alternative explanation, right? You test the marginal effect as well as the average effect simultaneously. That can help pin down the mechanism a bit.
Yeah.
Okay. Okay. And see. Do you guys have other questions? I'll make sure I'm using this function properly. Okay. Okay. If there's no other question, can I point one of you to ask a question or something like that? Yupeng, do you have any comments? I'm just randomly picking you guys.
No, I don't have any comment at the moment.
Okay, I'm checking if you are paying attention to the conference as an organizer. Okay. Okay, so let's take a short break. We will come back at 4:15 for the second paper. Okay, we still have like 20 minutes break, and we will come back at 4:15.